Welcome to today's discussion. I am Kunal from EPK Capital. If you are a non-resident Indian living in the United States or Canada, there is a very high probability that you are enthusiastic about India's economic momentum. India remains one of the fastest growing major economies in the world, and allocating a portion of your portfolio to Indian equity markets is one of the most compelling long term wealth creation strategies available today. For years, the go to vehicle for most NRIs has been simple: Indian mutual funds. You set up a systematic investment plan, let professional fund managers handle the stock selection, and watch your wealth compound over time. It feels familiar, simple, and effective. However, there is a massive hidden trap that catches thousands of smart North American NRIs off guard every single year. A common assumption is that as long as tax is deducted at source in India, when you redeem your mutual funds, your tax obligations are completely settled. Unfortunately, that assumption can lead to severe tax liabilities, unexpected penalty interest, and double taxation when you file your returns with the Internal Revenue Service in the US or the Canada Revenue Agency in Canada. In this video, we are going to break down exactly how cross-border tax laws view your Indian mutual funds, why standard investing advice can backfire for North American residents, and most importantly, how you can structure your portfolio legally to protect your hard-earned wealth. Let us start with the reality for NRs residing in the United States. The fundamental problem stems from how the Internal Revenue Service classifies Indian mutual funds. To the IRS, an Indian mutual fund is not treated like a standard US-based mutual fund. Instead, it falls under a complex category known as a passive foreign investment company, or PFIC. When an investment is classified as a PFIC, the default tax rules under Section 1291 of the US Tax Code are remarkably aggressive. Rather than enjoying long-term capital gains tax rates, which typically cap out at 15 or 20%, any gain you realize from selling an Indian mutual fund is taxed as ordinary income at the highest possible tax bracket, which can go up to 37%. To make matters worse, the IRS assumes that your capital gains accrued evenly across every single day you held the fund. They then charge a daily compounded interest penalty for every year you held that investment without paying US tax on the unrealized growth. By the time you calculate the ordinary income tax plus years of compounded interest penalties, your total tax liability can easily consume more than half of your total profit. On top of the financial penalty, the reporting burden is immense. You are required to file IRS Form 8621 for every single mutual fund scheme you own, every single year, regardless of whether you sold it or not. Now, if you are living in Canada, the tax treatment differs from the US PFIC rules, but it presents its own distinct set of traps. The Canada Revenue Agency operates on the principle of worldwide income. This means, as a Canadian tax resident, every dollar of capital gain or dividend income you generate anywhere on the planet must be reported on your Canadian tax return. The first major trap for Canadian NRs is currency translation. When you buy and sell Indian mutual funds, the transactions happen in Indian rupees. However, the CRA requires you to calculate your cost basis and capital gains in Canadian dollars, using the exact exchange rate on the date of purchase and the exact exchange rate on the date of sale. Because the rupee has historically depreciated against the Canadian dollar over long periods, you can easily end up with what is known as a phantom capital gain. Furthermore, if the total cost of all your foreign specified properties, including Indian mutual funds, bank accounts, and stocks, exceeds 100,000 Canadian dollars at any point in the year, you are legally obligated to file Form T1135. Failing to file this form properly carries strict penalties starting at 2,500 Canadian dollars per year. When investors discover these cross-border complexities, their immediate response is often Doesn't the Double Taxation Avoidance Agreement protect me? This is one of the most widespread myths in cross border wealth management. India maintains double taxation avoidance agreements, or DTAAs, with both the United States and Canada. The purpose of these treaties is to ensure you do not pay tax twice on the exact same dollar of income. However, a DTAA does not mean you pay zero tax in your country of residence, nor does it override local tax rules like the US PFIC regulations. Here is how it actually works in practice through the foreign tax credit mechanism. When you sell an Indian mutual fund, the fund house in India will typically deduct tax deducted at source, or TDS. When you file your tax return in the US using Form 1116 or in Canada using Form T2209, you can claim a credit for the tax already paid in India. This credit offsets your local tax dollar for dollar up to the amount owed. But here is the catch. If India taxes your capital gains at 12.5%, but the IRS taxes those same gains at 37% due to PFIC rules, the foreign tax credit only covers the 12.5%. You remain responsible for paying the remaining 24.5% difference directly to the IRS alongside any applicable PFIC interest charges. Beyond the actual tax rates, another significant challenge faces structural, the fundamental misalignment of tax calendars and currency tracking. In India, the financial year runs from April 1st to March 31st of the following calendar year. In both the United States and Canada, the tax year follows the standard calendar year, from January 1st to December 31st. This 3-month overlap causes severe synchronization problems. If you redeem an Indian mutual fund in February, that income belongs to the current Indian financial year, but it falls into the prior tax year for North American reporting. If your tax filings in both countries are not perfectly aligned, claiming your foreign tax credit becomes extremely complicated, often leading to temporary double payment while waiting for tax refunds or credits to process. Furthermore, many investors make the mistake of using year-end average exchange rates or current conversion rates when reporting past transactions. To remain fully compliant and avoid overpaying tax, every single transaction, from dividend distributions to capital redemptions, must be backed by official historical exchange rates on the precise dates those transactions settled. Now that we have covered the complexities, let us focus on the solutions. Participating in India's growth story does not mean you have to subject yourself to PFIC penalties or accounting headaches. There are highly efficient, fully compliant alternatives that allow North American NRIs to build long-term wealth in India smoothly. First, consider direct Indian equities. The IRS does not classify individual stocks of Indian companies as passive foreign investment companies. When you invest directly in shares of Indian companies through a non-resident external or non-resident ordinary portfolio account, your capital gains receive standard tax treatment in the US, qualifying for lower long-term capital gains tax rates and straightforward tax reporting in Canada. Second, for investors seeking professional management without buying individual stocks themselves, Portfolio Management Services, or PMS, offer an attractive structure. Unlike a mutual fund where you own units of a pooled trust, a PMS buys individual stocks directly in your own demat account under your name. Because you maintain direct ownership of the underlying equities, it generally avoids PFIC classification under US tax rules. Third, for ultimate simplicity, you can invest in US or Canadian domiciled exchange traded funds that track Indian market indexes. These funds trade on North American exchanges, issue standard end-of-year tax forms like 1099s or T3s, and completely eliminate foreign reporting complexity while giving you pure exposure to India's economic growth. Navigating international tax laws and wealth management requires clarity and intentional execution. If you currently hold investments in India or plan to invest in the near future, Here is a clear 3-step checklist to protect your wealth. First, perform a comprehensive audit of your existing Indian portfolio. Second, before making any redemptions or moving capital across borders, gather all necessary documentation. Third, consult with a qualified cross-border wealth advisor who understands both the Indian financial ecosystem and North American tax structures before making major asset allocation decisions. Now, as a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Make sure to stay till the end for a special surprise that I have for you. And if you happen to like the content of the video, please do like and share the video. Also, do subscribe to our channel for learning everything from the world of investments and finance to make your future a secured one. Structuring your global wealth correctly allows you to capture the dynamic growth of the Indian economy while preserving your capital against unnecessary tax leakage and regulatory friction. If you want to optimize your cross-border strategy, structure compliant investment channels, and ensure your global assets are aligned for long-term growth, our team is here to guide you through every step of the journey. Reach out to us to start a conversation about your global portfolio. At EPK Capital, we build wealth for generations.